The well-known Tesla bull Cathie Wood betrayed Tesla by purchasing some stock in GM after she met GM CEO Mary Barra last year. But if the latest news on General Motors are any indication, Cathie's betrayal is going to cost her dearly this morning. Some new information has come to light that shows points of major struggle for the automaker. These struggles could be a sign of bigger issues to come later this year. And into the decade, GM's collapse is knocking on the door, and Cathie's $13 million investment could go to zero. Renowned investment analyst Jim Cramer called this a year ago when Cathie bought GM shares for the first time. In Cramer's own words, Cathie's support for GM would signify a kiss of death for the company. But before we get deeper, smash that like button and subscribe. The GM is currently offering buyouts the majority of its U.S. salary workers. That is just the tip of what is lurking within the automaker company. Essentially, GM is looking to cut about $2 billion this year. And one way they're doing this is by offering employees the opportunity to leave. We've seen this with other automakers, and it was just a week and a half ago that GM announced the elimination of about 500 salary jobs around the world. Now the company is sending out offer letters to almost all of its salaried staff. How many people will take the buyout, and whether or not this will keep the company from having to initiate broader layoffs remains to be seen. Let me walk you through what I think is going on based on GM's Q4 earnings performance. They had flat sales in North America quarter after quarter, but there was an increase in inventory buildup in the same region. This means that they sold out the same number of cars, but the dealership inventories grew. Essentially, the net sale of cars sold to customers in Q4 were less than in Q3. Even though GM recognized it as a sale in their earnings report, all they did was move inventory from their factories to the dealership. Particularly for GM, network dealerships have an abundance of inventory. On the other hand, in November, brands like GMC, Chevy, and Buick Cadillac had a strong supply of 60 days' worth of inventory. Since then, the car industry has sadly been slowing down, and things don't appear good for GM. There is a serious issue at hand. Because dealerships were overstocking their best-selling truck, GM was forced to halt production of the vehicle. In actuality, consumers are simply purchasing fewer automobiles, despite the fact that this has been presented as an increase in production in the face of stable demand. Since SUVs and trucks account for the majority of GM's revenue, this is a precarious situation. The one product that generates the most money is being put on hold. The most costly vehicles on the market, pickup trucks, are the lifeblood of automakers such as General Motors, who depend on them for financial success. It's not looking good for Cathie and her ARC. Allocate money in 2022. Woods, Cathie for its autonomous technology and robotics art fund. ARC Investment Management purchased 158,187 shares of General Motors GM, indicating a shift from her previously held criticism of traditional automakers, which was revealed in a report summarizing the company's most recent transactions. According to Forbes, it would be a well-known stock picker who specializes in cutting edge for their companies. Tech companies oversee assets worth over $60 billion. After meeting with General Motors CEO Mary Barra, ARC Investment Management, which had previously criticized traditional automakers, recently expressed her admiration for the company's advancements in electric vehicles, autonomous driving technology, and its Cruise subsidiary, which is based in San Francisco. Yahoo Finance interview. During the meeting with GM CEO Mary Barra, they talked about the company's electric car projects and that the company was thinking about investing in GM while keeping an open mind about it. They also stressed the value of recognizing achievements and maintaining an open mind. This is a significant departure from Wood's previous criticism of GM and Ford's ambitions for electric vehicles, and her warning that they may go bankrupt again, citing GM's focus on Cruise automation and Barra efforts to turn the company around. It's difficult to overlook the severe slowdowns and job losses that businesses like General Motors are facing in the present economic environment. Slowdowns are unavoidable, but what's really important to know is when the next cycle will start and how it will impact auto manufacturers. I think there are two obvious candidates for the next cycle: attractive electric vehicles and reasonably priced automobiles. This ability is growing more and more concerning as the FAE tightens rates and people find it difficult to make ends meet. It should come as no surprise that Tesla was the only automaker in the U.S. to see annual growth in 2022. We've only just begun to see a noticeable transition away from gas power and towards electric ones. But there's also a big market for reasonably priced vehicles, especially electric vehicles. Where does GM fit into all of this? Automakers run the risk of lagging behind if they are unable to supply this. Sadly, it appears that they are having problems. Even though the Chevy Bolt is one of the more reasonably priced EVs available, it is not without problems. Several recalls have been issued for the car, which has reached its new owners. With production halts, layoffs, and other changes imminent, it is obvious that GM must change and provide an engaging, reasonably priced EVs if they hope to remain competitive in this shifting market. Affordable vehicles from GM, like the $45,000 Blazer EV and the about $35,000 Equinox EV, which go on sale in the autumn of 2023, could enable them to meet their objective. On the other hand, they must increase manufacturing of their forthcoming vehicles, such as the Silverado and Blazer Equinox, which should be launched in 2024 and 2025. In a competition to create an EV that is affordable for the general public, Tesla is far ahead of the pack. When Elon Musk, the CEO of Tesla, releases the affordable electric vehicle for sale, it will mostly function as an autonomous vehicle. Musk stated that a low-cost electric vehicle, EV, would be developed in 2020 with a target price of roughly $25,000. At Tesla's latest Investor Day, Musk gave an update on the car, although investors had anticipated hearing more details about the vehicle. In an interview at the Morgan Stanley conference, Musk revealed that the company's explicit plan is to produce a smaller car that will almost entirely run on autonomous power and cost roughly half as much as the Model 3. Musk stressed that Tesla values autonomy above all else, and that the company's greatest achievement to yet is the quick development of a fully autonomous system. Prominent CNBC host Jim Cramer, who is well known for his frank judgments on people and stocks, claims that Cathie Wood has a track record of changing his mind. This is demonstrated by her evolving positions on GM and legacy automakers. Wood just made her first acquisition of shares of General Motors after cutting back on her investment in Tesla Incorporated, a well-known manufacturer of electric vehicles. Cramer talked about the underperforming stocks of Ford Motor Company and General Motors during a CNBC episode last week. However, he was cautious to suggest investing in General Motors because he thought Cathie Wood's involvement might have a bad effect. Though DM seems to be doing well, I'm concerned about Cathie Wood's involvement since it might not be good. Cramer said, I believe Cathie Wood is the kiss of death, and DM is doing well. Jim Cramer warned investors not to buy General Motors stock on a recent CNBC program, according to Cramer, adding that it would probably take further substantial drops in the market before larger investors started to buy the stock. He used prior examples of Warren Buffett making purchases during market lows as support. These comments come after Cramer recently criticized Palantir Technologies, a stock linked to Cathie Wood. Wood was involved in the company in January during an episode of Mad Money, he said, so it's possible that the company would not have drawn much attention. Jim Cramer suggested to his audience that they short Cathie Wood and think about purchasing the Total Capital Short Innovation ECFA, which is made to wager against Wood's primary product, ARK Innovation ETF. He blasted ARK for having a drowning scene in the show and for being the ultimate hedge fund that held traditional growth equities. On social media, though, a lot of people were eager to draw attention to Cramer's earlier remarks, which were made less than a year ago, in which he called Wood a genius at the height of her ETS performance. Eric Balkunas, a senior analyst at Bloomberg, noted on Twitter that Cramer's proposal was ironic, given that the Woods ETF had dropped by 50% since his February 2021 first remark. Cramer advised Woods to stop making new investments in ARK funds and instead focus on enhancing performance, since legacy automakers have difficulty making the switch to EVs. Investing too little in inexpensive EVs at the beginning could be an issue. Tesla might take the lead since it has made significant investments in reasonably priced EVs. It's unclear how long GM and the EV business will remain profitable, and their futures are clouded. How do you feel about these matters? Please feel free to share your opinions in the space provided below. And sign up, we appreciate your time, and we'll see you in the upcoming video.